We have some very exciting news to report to you for Tesla stock that nobody is talking about. The consumer credit report came out from the Federal Reserve today, and your auto loans came in at $70.3 billion for the month of June. In all of Q4 in 2022, auto loans totaled $90.3 billion. Consumers are not slowing down. In fact, they're just taking on more credit. This has obvious implications for a recession years to come, but there is no recession right now. And this is a massive positive for Tesla stock. Our favorite stock is down 40% from all-time highs. I would argue mainly because there's this overarching fear that the Fed has raised rates so aggressive that we have to go into a recession, because that's what history has told us. Every time the Fed raises rates this aggressive, you go into recession. So let's discount Tesla stock. Let's make Tesla stock super cheap. Let retail investors make all the money. At least that is what they have been doing. As far as I can see, there's no recession out there, and this data furthermore proves that point. This could mean some pretty big upside for Tesla stock as we get closer to 2024 and then ultimately start Cybertruck deliveries in big numbers in 2024. And while analysts have 27% volume growth rates associated with Tesla and 29% EPS growth, the lowest in Tesla's over 10-year history as a publicly listed company, I'm not willing to make that bet if there's no recession. And it doesn't look like there's going to be a recession. I should also point out that consumer borrowing picked up in June. The latest Fed data is showing us consumer credit rose $17.8 billion in June, up from $9.5 billion gain in the prior month. Record borrowing is just under $5 trillion, even as credit card use dropped. So people aren't using their cards as much, but the money that they are spending on their cards is growing. This creates an interesting dilemma. On one hand, it means the recession is likely not coming anytime soon, but it makes that possible recession down the line much worse. Meet Kevin actually reported this quicker than I could, so props to you, Kevin. I'm gonna let him explain this in about 60 seconds, why this is a big deal in the longer term and really good in the short term.
Well, in my opinion, here's what happens. And obviously I don't have a crystal ball, but my expectation is if you have credit contraction going throughout 2022, and then you get a reversal in 2023, what you actually end up getting is no recession in 2023. You actually end up getting more spending and more indebtedness eventually from consumers. Eventually, those consumers will not be able to support their household payments anymore, and then you get default, and that's where you actually get a real recession. So if we're potentially right here in 2023, then this X date, I do not believe, that's your default date, right? I do not believe that X date actually occurs until sometime long in the future. Like, I don't think it's 2024. Maybe is it 2025? Probably not. It's probably more like a 26 to 30 instance.
If you are someone that does fear a recession or think one is coming, you need to watch this chart on a monthly basis at least. And it is from the Federal Reserve. It's the household debt service payments as a percentage of disposable personal income. And you've never seen a recession in recent history happen unless this chart was above 10.3%. And this happened back in Q3 of 1981. And obviously, besides the COVID recession, we're about at the same level we were right before the COVID recession happened. But that was brief and that was artificial, to say the least. The average recession since 1980, your household debt service payments as a percentage of disposable personal income is about 12%. That's your tipping point to where you likely get a recession. Back here in 2007, 2008, This was over 13% back here in 2001. This was over 12.3%. And back here in the 90s, this was 11.5%. So your rough average is around 12% here, and that's your tipping point. We're far from that. But as consumers continue to take out more and more debt, this chart will increase unless the wages continue to outpace the debt, and that can happen for a little while and postpone this even more. But eventually, as debt continues to build, this will be a problem, but not in the way that Wall Street thinks it will be for stocks like Tesla coming next year. It's simply not going to happen. This is some of the easiest money you could make on Wall Street today by buying Tesla stock, in my personal opinion, based off of this fact, as well as many other things we cover every single day. Now, shall we talk about Lucid? They are literally going bankrupt, my friends. They missed on revenue expectations after EV deliveries disappoint. Lucid generated about $150 million in revenue in the second quarter, less than Wall Street had expected. Deliveries also fell short of expectations, but they did raise $3 billion of capital in May that has extended the company's cash runway by about a year into 2025. I think this just highlights how unprofitable it is to make electric vehicles. Tesla has done something miraculous here. They can make an EV at a profit. Nobody else can say the same, at least domestically here in the US. Lucid's net loss for the quarter was $764.2 million. Revenue was expected at $175 million. So this is one of the worst earnings misses that I have seen on any stock during this earnings season so far. And you have this very weird note. It says EPS came in at negative 40 cents. It was not immediately clear if that was comparable to Wall Street's expectations of a loss of 33 cents per share, according to analysts. I don't even know what this means. This is the first time I've ever seen this before, ever. What does that even mean? Why is this even here? Doesn't make a whole lot of sense. Lucid delivered 1,404 Air sedans in the second quarter, 600 fewer than Wall Street had expected. Lucid had $3.4 billion in cash and an additional $700 million in available credit lines as of March 31st, which it said at the time was sufficient to fund its operations into the second quarter of 2024. They're literally, or were, 6 months away to bankruptcy. Pretty rough out here if you're not Tesla. As malicious as it sounds, as a Tesla investor, this is also good news for you. I don't see a pathway to getting to a place of sustainability for Lucid. The odds are over 50% this company ultimately does go bankrupt. And I think it highlights a broader problem Ford and GM and the likes are going to have, that they're not going to be able to produce a profitable electric vehicle for a long time. That also opens up the possibility for full self-driving. Ford or GM, they're not going to want to spend billions of dollars to create their own software as they lose billions of dollars making EVs. It's pretty simple. Tesla's your only alternative. Something pretty exciting that happened as well today is the sellers, the shorts, got exhausted. Tesla stock was down about 4% at one point today, closed down 0.95%, less than 1% down, on a day where the CFO of over 4 years stepped down, was either fired, retired, doesn't matter. Tesla stock reversed from the lows that we've seen of the day today at $242.76 to where we currently are at $251.70 per share. What's so important here is Tesla flushed under that 250 support level. It had no respect at the 250 level earlier in the day today. You came down, you almost hit the 240 support. You found support right above that, and then you retraced all the way back above the 250 support to close. Now, why is this so exciting? Well, this shows a lot of strength for Tesla stock. And I've said it before and I'll say it again. If the markets don't crash, I don't expect Tesla to crash. Now, obviously, I couldn't foreshadow the CFO stepping down, things of that nature. You have to take into consideration as well. That's always a possibility. We get some really bad news or big price cuts, things of that nature. But without any bad news for Tesla, well, it looks like the stock is going to mirror what the markets do, but it's going to amplify that because Tesla has a very high beta. So it means it just does a lot more than what the markets do. If the markets are down one day, Tesla's going to be down a lot more. If the markets are up a lot on any given day, Tesla stock's going to be up a lot more. But this shows a lot of strength with Tesla. Specifically, the candlestick that we formed today is a very bullish one. It's called the hammer. The hammer candlestick may indicate that a stock has reached its bottom and is positioned for trend reversal. This is essentially a big move down intraday and then a recovery towards the end of the day to close almost where you opened on the day. And that's exactly what happened today. Now, according to Carter Worth, you guys have seen this guy on CNBC. He's real good with the charts. He thinks the S&P is due for an average correction of about 9%. This would be the third correction that we have seen since the October lows.
Next guest says the market's in the middle of the third pullback since that recovery began mid last October. Here to explain from a technical perspective is Worth Charting founder and CEO Carter Worth. It's good to see you, Carter. And I remember talking at the turn of the year when we were bearish and it all looked terrible, and then it just kind of like took off on us. So put that upward rip in context of the larger thing that you think is going on here.
Right, so we obviously impressive strength since the October 14th low of last autumn, which is in many ways almost as impressive as the preceding sell-off. We know that global equities peaked on 4 January 2022, and S&P drops 27%, NASDAQ 100 drops 37%, and then since that October low, we've been recovering. But the market, as in any instance, whether you're going up or down, is always characterized, or most always characterized, by counter trend moves. So on the way down, that 27% decline, we had these very important counter trend moves, these sharp rallies, which gave way to new lows. Well, so too, from the low of October 14th to where we are now, we have had two very distinct counter trend moves, sell-offs, drawdowns, corrections. There was the December 1 to December sort of 22 sell-off of about 8.2%. Of last year since the October low. There was, of course, the second one from February, March of this year, down 9.2. And now is this current day-to-day, week-over-week sell-off the third normal garden variety sell-off? I think that's what we're looking at.
So then what comes next, under this rubric?
Right. So first of all, it would have to be complete, right? Meaning dropping 1%, that's nothing, or 3 or 4, meaning something happens once you go down 5%. We spend a lot of time looking at that, whether it's because that's where people's stop losses are entered or risk managers come into the room and say, you've got to pull back here. But if you look at all 5% plus sell-offs in the history of the S&P, going back to the 1930s, the median and mean end up around 9.5%. And so we're down 2.8. I think we will get that 9%, and that will be a proper correction, right? And so from there, we'll see. But it's in the etymology of the word, right? Why would we use the word correction unless the implication is that the preceding circumstance is incorrect, which is exactly what it is. If something gets too steep or ahead of itself, it needs a pause, a rest, a break.
So I'm going to ask again for those of us who are a little dense here. So
no.
Are you saying then that the larger kind of rally trend that we've been on post-pandemic is intact, or is it ending here?
Oh, well, no. So it's really more about sequencing, I guess is what I'm saying. If you were to just observe the market in any period or any stock or currency or commodity, and we know when you're an uptrend or downtrend, those are invariably punctuated by counter trend moves. Obviously, if you're an uptrend from the October 14th low, you typically will see on any given 2 to 4 month basis some sort of meaningful give back. And you can see it on the chart here. That is a very well-defined channel. We hit the upper band to the penny, and that's associated with the Microsoft Apple stall. Were we simply to go to the bottom of that channel, it would be right in line with the preceding other two proper givebacks. And so that reset, if you're bearish, you believe that's not going to stop there, it's going to go a lot more. And if you're bullish, you want this reset in principle because it what allows you to go yet further if you're going to continue higher, which is to say, if you exert yourself too much in the gym, you must take a rest, or you have the coronary. You do it in the library for 9 hours, you hurt your eyes and you actually blow the test, or you go take a rest and then you come back and do well on your exam. Point being, we're at a point where whether you're bearish or bullish, one can anticipate or want a proper garden variety sell-off, correction, dip, drawdown, whatever nomenclature one prefers.
Bulls should want a 10% drop here. That's the Kelly headline. There we go.
Sure, here is. You know what? I'll give you a little anecdote. My very first boss was a big horse nut, and we would go to the track. This was I was a kid, and all of a sudden he'd throw his tickets away. These were $4,000 and $5,000 bets in the 1990s, and the first thing was done. The first quarter turn, he goes, "That horse, my horse, is way too fast. He's ahead." And guess what? Every time his horse ended up last. You come out of the gate too strong, you can mess things up. You want breaks and rest along the way.
The big catalyst that we have this week is CPI on Thursday. This comes out at 8:30 in the morning. This is the catalyst that would really start this correction or get it going aggressively, for lack of a better word, if we are to see a correction. Your year-over-year inflation rate is the number to watch. We're not expecting anything else to move. All of this is expected to stay the same from last month's rating. That's the core inflation rate month over month, the headline inflation rate month over month, and the core inflation rate year over year. But your headline inflation rate year over year is expected to rise to 3.3% from 3% last month. If you see this number come in higher than 3.5%, we have a problem. If this number comes in at 3.3%, well, that's still a pretty big uptick from last month's year-over-year number. That's probably not going to be bullish as well. That's probably going to be quite negative. I would expect about a 0.5% drop. If this number comes in over 3.5%, I expect a 1.5% to 2% drop. If this number comes in at 3% or 3.1%, I would expect anywhere from a 0.5% move up to a 2.5% move up. It would be very encouraging. Odds are inflation comes in about 3.4%. You're somewhere in that range of negative 0.5% to negative 1% in the broader markets. So what we unpacked for you here in this video is the fact consumers are spending through this long foreshadowed recession, and it doesn't look like a recession is coming. And that's really been the main reason why Tesla is down 40% from all-time highs. And if we don't get a recession, analysts' estimates for 2024 are way too low. This is easy money for you as a Tesla investor today, but it does mean that recession, which could be years down the line, is going to be a pretty bad one. Okay, that's important to know. Good in the short term, really bad in the long term to see debt that is continuously being added to the way that we have seen in the past couple of years. Not to mention that Tesla's competition is literally going bankrupt, and that is Lucid, as well as many other companies as well. Really highlights the problem even your legacy automakers are going to have when they try to produce a profitable EV. It's just not going to be possible for many, many years to come. And we also highlighted that the markets are probably about to go through a correction. Obviously, trying to predict the markets is a fairy tale. You can't predict it. But as far as what Carter Worth says, we're heading into a correction. That could mean more downside for Tesla. That could mean more downside for obviously the broader markets. That would be your ultimate buying opportunity if you did not get the chance to do so under that 240, potentially 230 level on Tesla. So that is going to do it for this video. Hit the like button and subscribe to the channel on your way out. If you guys want to come trade with me live in real time every time I make a trade, linked down below in the description of this video. Most importantly, and I mean this, enjoy the rest of your day, and I will see you in the next one.